Thank you for joining today's webcast. Your moderator for today is Mr. Van den Brekkel. Mr. Van den Brekkel, you may begin.
Thank you. Welcome everyone to this EY Thought Center webcast on the reports from the Beige Erosion project that were released by the OECD. Today we will specifically be discussing the final report on actions 8 to 10 that deals with aligning transfer pricing outcomes with value creation. Thank you for joining us. It's a pleasure to have you with us. My name is Ronald van den Brekkel and I will be your moderator for today. In today's webcast, we will look at the various topics in the final report on action 8 to 10. The report contains revised guidance which, in the OECD's view, is aimed at ensuring that the transfer pricing rules secure outcomes that see operational profits allocated to the economic activities which generate them. It represents an agreement of the countries participating in the OECD G20 BEPS project. For countries that formally subscribe to the OECD guidelines, the guidance in this report takes the form of amendments to those guidelines. The topics covered by the final report include revised and new guidance regarding the application of the arm's length principle, including guidance on synergies, location savings, delineating the actual transaction and risk allocation, the transfer pricing aspects of intangibles, including a new approach for hard-to-value intangibles, intra-group services, cost contribution arrangements, and commodity transactions. We will touch on some of the implications and possible actions for companies operating internationally, and we will share some thoughts about how this may impact companies in specific industries and specific countries. We have assembled a global panel with diverse and significant experience for our discussion today. Let me introduce the panelists. With me is John Hopster. John is EY's global transfer pricing leader. John has more than 20 years of experience providing strategic transfer pricing advisory services, and he focuses on some of EY's largest and most complex clients. Also with me is Tracy Fultz, US Northeast Region transfer pricing leader, and works predominantly with technology, consumer products, and life science clients. Her significant experience includes valuing tangibles with high profit potential and how to divide such profits between functional and risk-bearing activities. And a special welcome to Joanne Su. I know it's very late for you, Joanne, and Joanne is EY China's transfer pricing leader. She has been working closely with the Chinese tax authorities on the implementation of BEPS in domestic regulation and will provide her insights today on some of the important issues. Let me remind you that during the webcast you have an opportunity to raise questions, and we will get to as many as we can during the time we have today. During the webcast we will also be asking a number of polling questions. Please bear in mind that responding to these questions is required in order to be eligible for the CPE credits for this webcast. To make sure we focus on the technical and practical content of Action 8 to 10, we will not interrupt the webcast to share the results of the polling questions with you. And John, before we talk about specific topics, can you provide some context and a brief summary of the final BEPS report in respect of the Actions 8, 9, and 10?
I'll do my best, Ronald. They're very long, of course, but as you mentioned, they cover a variety of topics, and we're going to get into most of those in some detail during this webcast. But if I have to break them, broadly speaking, into the key chunks, there are three. First, Action 8. The work there looked at transfer pricing issues relating to transactions involving intangibles. Now, obviously, the allocation of profits generated by valuable intangibles is really, really important, both for tax authorities and for our clients, multinational businesses. I think in summary it's led to a broader definition of intangibles than ever before, and the introduction of this DEMPI concept, which we'll get into. That will change the way we think in which transactions involving intangibles have to be analysed and how they have to be documented. We'll get into that in some detail. Second, under Action 9, there's some very important stuff considering the contractual allocation of risks, and of course then the resulting allocation of profits to the entities that assume those risks. And it may not correspond always with the activities actually carried out by those entities. So again, we'll dive into that in detail, but the work addressed the level of return to funding within a capital-rich company, pure funding and some variations. And thirdly, under Action 10, there's some work focusing on what are called other high-risk areas, including the scope for recharacterization of transactions by the authorities, and some interesting stuff on low value-adding services, and then finally some thoughts on transactions involving commodities. I suppose gluing it all together, thinking what the overarching statement might be, it's fair to say that the new guidance really places a very strong emphasis on the substance of transactions and the actual conduct of the parties involved. At the same time, the new guidance does explicitly confirm that contractual arrangements remain the starting point of a transfer pricing analysis. So there are some key examples in there, but the introduction of a new analytical framework for the analysis of risk and one for analysing transactions involving intangibles are certainly the most important things that we'll cover today.
Thank you, John, for providing that context and summary. And now, before we start digging a little deeper into the content of the report, I would also like to talk about the status of the report and some of the practical implications. For example, the question as of when the changes will become effective. And Tracy, may I please ask you to start by providing some information about this, and specifically, how does the IRS deal with this?
Okay, thank you, Ronald. I think the OECD BEPS explanatory statement indicates that some of the revisions of the BEPS project may be immediately applicable. Revisions that falls into this category are actually the 8 through 10 guidelines. So OECD mentions that basically for the countries that formally subscribe to the OECD guidelines, that the guidance in Actions 8 through 10 report takes the form of amendments to the guidelines themselves. What this practically means is that the amendments are already included as of this report, and so it really comes down to process of the OECD and what has to happen next. So as far as process, the OECD basically has to approve through the OECD Council. They've already reviewed the amendments in 8 through 10, so it's not expected through that approval process that there'll be any changes, and it's actually expected that that approval process will happen in early 2016. So effectively what that means is many of the countries will immediately adopt the principles of Actions 8 through 10, and that in some cases no change or law treaty needs to be amended. What we actually have observed is we did an EY study that basically asked the countries, what do you think the impact of the changes will be? And they've said they think there'll be immediate impact of these changes. We've also, I think, seen IDRs from different governments basically requesting information relevant to Actions 8 through 10, even though 8 through 10 is not mentioned on the IDRs themselves. And so we're also seeing that coincidentally in Action 13. We do know of several information requests by the IRS asking for the information that's included on the C/C report, but not really referencing the C/C report. And on those items, it's particular to note that these are back years. So they're not asking for the information as of when Actions 8 through 10 came out, as of October. They're really asking for back. So the idea and the concepts that are included in this have already started to take hold. One other thing to note, I think, is in relation to application of these principles and the MAP procedures. So obviously, MAP is mutual agreement procedures, and basically what happens there is this is another example where no changes in the domestic law are required, since the application of Article 9 of the OECD model tax convention already outlines the MAP procedures. So essentially, OECD has stated that they believe these amendments will be used in the MAP procedures going forward. So with that, I think obviously this is substantial change and a lot of guidance, and it may not be possible to pinpoint this is the exact time period people will start to rely on these, and I think practically speaking, we're already starting to see them use the guidance.
You already referred a bit to the U.S. view on and the IDRs that were issued with regard to country-by-country reporting, or at least they don't call it country-by-country reporting. If we look at it a bit more substantively, the Actions 8 to 10, any specific comments on the U.S. view on that?
So I think most people already know that the U.S. revised its transfer pricing guidelines several years ago, effectively sharing regulations with respect to how to value IP and then putting a cross-reference in the regs. And so they really view that they've addressed a lot of these issues by those changes in the methods. And where they focus their comments on in the draft are really related to the risk tests that we'll go over later. And so I think the view from the U.S. is really they've handled a lot of the IP stuff through their changes, and they really were focused on the risk sections.
Okay, Tracy, explaining. Looking at another a specific country view, if I recall correctly, there's a footnote in the explanatory statement, a specific footnote in the report on Brazil. Can you tell us some more on that?
Yeah, so I think the biggest thing to take away from that is actually this is not just OECD countries. It's broader, and it included countries like China, India, Russia, and Brazil. As many people know, Brazil itself provides an approach in its domestic lend for transfer pricing that really relies typically on fixed margins derived from industry practices, and it considers that in line with the arm's length principle. And so the footnote basically states that Brazil will continue to apply its approach and use the guidance in the report in this context. And so when Brazil tax treaties contain the paragraph on the arm's length principle, paragraph 1 of the OECD and the UN model tax conventions. And so where there's a case where there's double taxation, now because those provisions are actually in the Brazil guidance, the guidance will be considered in double taxation cases. And so I think that's positive news for taxpayers, because the Brazil double taxation issues are pretty substantial for people.
Yeah, thank you, Tracy, and that's good news indeed. Comments on the status and the practical implications. Then, as a first technical topic, John, can we talk about the general part of the report containing the updated guidance on the application of the arm's length principle? This is a very generic title, but what does it entail, and what are some of the key changes in the report in this regard compared to the existing version of the transfer pricing guidelines?
Well, Ronald, there are substantive changes, really. I think we're going to get into a lot of detail on some of them. I've already promised that we'll come back to them. So the key points are that it takes the point here that we've got to identify the actual transaction undertaken. As I said earlier, that can start from an evaluation of a contract, but we've got to look at behavior as well. We have to look at what is meant by controlling a risk. The point here being that profit relating to risk attaches to the people controlling it. And we have to look at the circumstances in which the actual transaction undertaken could be disregarded by the authorities for transfer pricing purposes. We see examples all the time, like you would never have done that. The taxpayer would never have given away the crown jewels, that kind of thing. We'll come to all of that later because it's substantive and it's lengthy. In addition, there's some important stuff on comparability factors in transfer pricing, things that don't go as far as being intangibles, but have been asserted by some authorities over the years to be such. Things like location savings. And then there's quite a lot on assembled workforce, and there's things like group synergies. My eye is drawn to the stuff on group synergies. I find that particularly interesting. And what it says in a nutshell is that when there are synergistic benefits that arise purely as a result of being part of a group, a bit like the US concept of passive association, passive synergistic benefits, then they don't have to be separately compensated or specifically allocated amongst the members of the multinational group. So that's pretty clear. But, and this is important, if group synergies arise as a result of deliberate, concerted group actions, then those synergies should be shared by the group members in proportion to their contribution to the creation of those synergies. Now, we've done a lot recently to understand and work with our clients on the implications of centralized procurement, activities relating to sourcing and procurement. And the OECD's taken a fairly robust position there that the mere volume-related benefits, that is, a group of companies bundles together all its purchasing power and gets a better price from its suppliers, and that's all it is, volume aggregation, then those synergies should be allocated to the donors of the volumes, that is, the people who've allowed it to be bundled up. So that's quite extreme. But then we have, in those circumstances, the view that the centralized procurement company, which we often see, should receive as a reward for its procurement activity only a routine return, a kind of service fee. Now, that's potentially okay if we are dealing only with the aggregation of volume, and it's actually carefully that way. But if we've got more than that, if we've got the kind of things that a lot of our clients have been setting up, highly skilled central procurement functions who do far, far more than aggregating volume. You know, they have technology relating to e-auctions. They go as far as actual interface with the supplier base and smart negotiation. There's all sorts of things going on. And then in those cases, we think that you would have to undertake a very detailed analysis, but in concept, something more than a routine amount would go to the procurement company. Now, there's all sorts of other examples on similar concepts relating to the pricing of loans and guarantees, but this whole idea of whether synergy is a kind of passive bundling or whether it's a concerted and deliberate action for which a charge should be levied is, I think, particularly interesting and not straightforward.
Thanks for that, John. And you were addressing comparability factors, and I think, in my view, one of the key changes is this general part is also the process of comparability, the new 6-step process that has been introduced. And Tracy, maybe you can tell us a bit more about this 6-step process.
Yeah, and Ronald, you're exactly right. I mean, this was one of the more notable changes with respect to these drafts, and it really is regarding comparability analysis. Specifically, there's a new 6-step approach. It really demands a more detailed analysis be performed as part of the functional analysis, covering functions, assets, and risks. The test, there's a 6-pronged test. It's devoted to risks, and that's not really to say that the risks are more important than the functions or assets. Instead, I think it's to address the point that risks can be just more practically difficult to explain. Oftentimes, management of a risk within a business means there hasn't been an upside or downside, so it's harder to a risk and documentation and prove that it actually exists. And so what they're really asking people to do is do more diligence around describing those risks and explaining what the upsides and downsides are. And so I think that really what this means for the taxpayers and the clients is a more detailed analysis around those risks and the test itself.
Thank you, Tracy. And John, Tracy explained that one of the steps indeed relates to the issue of controlling of the risk. It's not entirely new, and it was also in Chapter 9 of the OECD guidelines after the changes on business restructurings that were introduced in 2010. In your view, John, what makes this new guidance on risk so interesting?
No, I think it's really steps 3, 4, and 5 of the 6 that need to be looked at. They essentially evaluate the alignment between a contractual allocation of risk and the management of that risk. In effect, they're testing whether the entity that assumes the risk by contract also exercises control over that risk, and whether it has the financial capacity to assume the risk. The financial capacity seems to me to be relatively straightforward, not totally, but relatively. But this idea of control is, although not new, requiring some definition here. So the main difference between what's said about controlling risks in the current Chapter 9 of the guidelines and what's said in this new guidance is the fact that we now have this clearly defined analytical framework. And what does it do? It defines management of risk as having three elements. First, the capability of active decision making with regard to the risk. Second, the capability to make decisions on whether and how to respond to the risks. And thirdly, the capability to mitigate those risks. So for all three, we get references not only to the capability, but to the actual performance of the activities. And fundamentally, to say that an entity is controlling the risk, it needs to perform the risk management, although it can outsource some elements of the day-to-day elements of that. We also get some stuff on financial capacity. What does that mean? The financial wherewithal to control the risk. It's access to the funding of the risk. So in the guidance, we get an explanation that we have to look at it from an independent party perspective as to whether a party would have access to the funding. So let's take an example. Exploiting an income-generating asset could, in a third-party situation, create an opportunity for an entity to obtain funding that might be needed. So this new guidance doesn't just look at the funding as it is, but it picks up the theme of options realistically available to obtain the funding. And these are quite subtle constructs, but they do give us some degree of clarity when you penetrate all the language. I think I'd also like to just pick up on one very important change compared to the prior discussion drafts as we've gone through to this final one, issued by OECD. And that is this, that despite the emphasis which will pervade this webcast on physical activity, not to the exclusion of, but with a higher ascendancy than compared to, say, risk and asset. Despite all of that, this report makes it crystal clear that the starting point of the analysis is still contractual arrangements. So the draft guidance, before it, there seemed to be far less value assigned to contractual arrangements. If anything, the value to some of the points we're about to raise has increased in the final draft, and I'm sure many people will have noticed that.
Thank you, John. And we will continue with the six-step process, but I want to address one of the questions that came in from the audience, and which is about the application of the new guidance. And Tracy, maybe you can answer that question. The question reads: in practice, is treatment being seen more as a clarification of existing guidance rather than to be applied prospectively? What is your view on that?
So it's really hard to answer that because I think the general view is that clarifications to existing guidelines would be implemented now, and possibly even retroactively, to be honest. But the new guidance would be potentially just as of when the OECD Council adopts in 2016. So I think it's really hard to say, like, wholesale that everything will be adopted right now. I think there are things that are specifically different. For example, special measures test around hard-to-value intangibles were not previously in the guidelines, and so that's very different, I think, from the guidelines themselves, and it would be hard to believe that governments would treat those as clarifications to existing rules. So it's really, in the end, going to come down to which part of these guidelines are you relying on, whether or not it's a clarification of existing rule or if it's actually considered new guidelines.
Yeah, I agree with that, Tracy. I think there'll be some debate on specific cases, but I think you have to regard the direction of travel as being that the people who drafted these guidelines and all the contributors to them will generally seek to assert that they are clarifications of the arm's length principle, right? There's still an arm, there's still a length. So I think it's a very, very good question, and I agree totally with your answer, Tracy.
Yeah, well, thanks, John and Tracy, for answering that question of the audience. And let's continue with the six-step process. A lot of emphasis there on the actual delineation of the transaction, quite a tongue breaker for me, or finding the real deal. And Joanne, with the focus on functionality, how do you see the role of intercompany agreements in Asian countries? In your view, what does the new guidance mean for intercompany contracts?
So thank you, Ronald. I think the new guidance is very helpful. Traditionally, the emphasis on intercompany agreement in my region is not as high. It is not always a case to see exemplary intercompany agreements that clearly craft out the economic risk and contractual arrangement for the risk. In many cases, the intercompany agreements do not exist. So in this region, tax authorities are very familiar with limited risk structures, and they will be challenging this more and more for cases where the terms are not supported by actual management and control of the risk by the decision-making process. So intercompany agreements and alignment of the contracts with the transfer pricing policy will become essential to defend these limited risk structures. So the agreement will be the first place to document the supply chain, even before the transfer pricing documentation process commences. And of course, the material intercompany agreements, they will become part of the local file as well. At this point, Ronald, if it is okay, I'd like to make a quick detour to mention China. As you know, China recently, in mid-September, issued the consultation draft to the current transfer pricing regulation incorporating BEPS. China is the first country in Asia to implement BEPS, and we expect the new rules to be effective as early as 1st of January 2016. So back to my point on agreements, China rules will refer to recharacterization. Going forward, this means that if contractual terms are not consistent with the actual conduct, tax authorities will have the basis to recharacterize the transaction accordingly. So I believe with BEPS and with China taking the lead, a trend will start with local tax authorities in the region.
So Joanne, you're effectively saying that there should be more emphasis on intercompany agreements with the new guidance, since the agreements can be used to help substantiate, for example, a limited risk structure, but at the same time, the actual conduct must be in accordance with the contract. So for me, it seems a bit like a paradox. If actual conduct is of primary importance, why should taxpayers need to pay a lot of attention to contracts and to the transfer pricing policy?
Well, I agree. It would be straightforward to look only at the actual conduct, but in practice, the legal or contractual arrangements will still be necessary. And of course, this should be aligned with the transfer pricing policy, which is very important. Arguments have often swung between the legal form and economic substance, depending on the circumstances. I think the term economic substance over legal form or vice versa is not as relevant anymore. Rather, both legal form and economic substance are important and should be consistent with one another. I think that is the key point. If one looks carefully at the draft rules for China, this balance is also emphasized by the SAT as well.
Okay, thanks, Joanne. And we touched upon the actual delineation of the transaction or the search for the real deal. Tracy, in your view, what will be the practical implications of this search for the real deal?
I think really what the guidance is trying to drive home is clarity that there needs to be congruence among the legal contracts, the substance, which we've talked about both of those, and the third peg is really the comparables. So do all three of those things align? So basically, you said you were going to do something in your legal contract. Did you do it? And do your comps align with what you're actually doing? And the practical implication is none of these items are going to perfectly align, right? Things change in businesses. And the question is really, are any of the changes or any of the misalignment material enough to require adjustments to the comparables? So practically speaking, anytime there's misalignment, there's potential for a taxing authority to raise the issue of the misalignment. And basically what that will mean is that taxpayers will have to demonstrate there are no material misalignments, and when there are misalignments, that either they made adjustments to the comparables or adjustments were not required. And so I think the emphasis on the search for the real deal is really likely to lead to more tax disputes over these misalignments. And I think what will happen is taxpayers effectively will start using either advanced pricing agreements to try to manage the risk or MAP. And we discussed earlier that MAP will consider the revised OECD guidelines. So in many cases, I think where people aren't using APA in advance, audit-ready files will become incredibly important that those three items are truly aligned.
Okay, thank you, Tracy. And staying with the subject of control, Joanne, I learned that the SAT has an interesting view on controlling risks by entities outside China. I have, in practice, experienced similar positions in India as well. Can you explain this position in a bit more detail? What does it mean for multinational enterprises?
Well, Ronald, the Chinese tax authority is of the belief that the China domestic market is one with many unique market factors, and it is not possible for someone sitting in the US or Europe to be able to develop a successful China market strategy or make effective decisions on strategy and pricing without important insights, experience, and guidance from the team in China. For many multinationals, this view of the surprise. I think from a Chinese perspective, the model setup has to look convincing from commercial and practical standpoints. When designing the business model, consider one, whether it is possible for certain functions and risks to be practically assumed by the principal outside China, and two, whether the relative substance in the local Chinese entity versus the principal entity. What do I mean by relative substance? For example, if China has 3,000 employees involved, in the whole process from design, production, to sales functions, and the principal has 30 employees with management and control functions, it may be hard to demonstrate that China is a limited risk structure with T&MM return and all the residual profits belonging to the principal. Of course, you have to look at the industry and the economic circumstances, but it is very important to formulate a commercially viable explanation and have strong documentation to support the position.
Thank you, Joanne. And I think the China example shows that although there is consensus amongst the OECD countries and the BEPS countries, that it's very important to see how the individual countries are going to interpret the guidance that has been issued. That brings us to the following major topic covered in the final report, intangibles. Over the past few years, there have been many discussions about this topic in the OECD, and after various discussion drafts and public consultations, the OECD has now finalized the new guidance regarding the transfer pricing aspects of intangibles. And as John has explained in the introduction, there's a variety of topics in the intangible section. A definition of IP, a broader definition than just legally protected assets, and also what should not be considered an intangible, like location savings and synergies. The analytical framework to determine the ownership of intangibles and identification of the so-called DEMPI functions, but also the practical guidance on pricing of intangibles, both for the ongoing use and for the transfer of intangibles. And in this section as well, new guidance on hard-to-value intangibles. Joanne, we have received some questions on what the new guidance means for location savings and location-specific advantages, and on the Chinese view on that. Can you shed some light on that?
Yes, so Ronald, as said before, China is one of the very early adopters of BEPS in Asia, and will likely by end of this year issue new regulation with the contents reflecting what is in the final report. The additional guidance on location-specific advantages will have a significant effect on emerging countries in Asia, like China, India, Indonesia, etc. These countries have market features that will allow them to argue for LSA in their jurisdictions. Taxpayers will almost be certain to expect arguments on LSAs. In China, the new rules expect that all TP audit settlements and APA will include comparability adjustments to account for LSA premium and location savings. So this is all expected since LSA discussions have been around for a while. I think the challenge faced by companies is how to quantify the economic effect of these factors and perform the necessary comparability adjustments. So in emerging markets in Asia, we often see local government insist on contractual rights and government licenses, which may limit the number of players able to enter the market. I think this is another important point in this discussion on intangibles. And these are very important, and economic consequences from having the market access should, in a tax authority view, be reflected in the profits of the local subsidiary.
Joanne, this is somewhat confusing to me. I always had the impression that China and some other countries in the region are considering market features as a kind of intangible and not just as a market comparability factor. Is it clear for companies now how to deal with this in practice?
Well, this is the view the SAT had earlier before the BEPS project. We had many long discussions with SAT on this point for various projects. Fortunately, with the BEPS final reports that clarified this point, I believe the SAT now has a view consistent with the OECD guidance.
Okay, thanks. And let's continue with the other part on intangibles, Joanne.
Yeah, sure, Ronald. So I think a final point to the market features is the treatment of the government licenses, as I mentioned. So in the past, such licenses were not viewed by the SAT as an intangible. The OECD report mentions that the regulatory and government license may be an intangible and may have substantial value. So this new guidance will definitely impact the way how profits should be allocated to subsidiaries operating with such licenses.
Let's look at the industry view on that, the fact that the new guidance on licenses and regulatory approvals. Tracy, in your view, which specific industries may be impacted by this new guidance?
Yeah, I think the one thing that stands out is we have a lot of regulated industries who are dependent on regulatory approvals and local country licenses to operate in the companies or in the countries. So specific industries that come to mind are really like life science industries, oil and gas, as well as portions of consumer products that require local country approvals and regulatory approvals.
Okay, thanks, Tracy. And from local market features, it's quite an easy step. It's a small step to marketing intangibles. We have quite some questions on that coming in. Any interesting news here, Joanne, on marketing intangibles?
Indeed, Ronald. Another area that is already common discussion for intangibles is the importance of the trademarks, trade names, and brand names versus local marketing and promotion efforts in countries like China and India. So at what point the marketing and promotion efforts in countries, like China and India will be starting to be creating a value for the marketing intangible that is owned by the parent. Quite often we see tax administrations in developing countries arguing that companies operating in their markets incur more significant marketing and promotion costs compared to those entities or subsidiaries in the developed countries. And that this should often be taken into consideration when we perform the transfer pricing analysis. So India adopts a bright line test approach to disallowing excessive costs. In China, the authorities may seek to take on a different approach depending if the products are either locally produced or imported products. So the additional chapter in the draft Chinese rules refers to collection and analysis of marketing intelligence, establishing of sales channel, management of customer relationships, brand promotion activities, all as important functions contributing to the value of intangibles. So here the Chinese position seems to be somewhat broader than the OECD view.
Thank you, Joanne. And we have a question coming in saying, well, any thoughts about the situation that if you have an R&D intangible in one country and a marketing intangible at the other side? I think this is a question that has been dealt with in the past quite extensively in some cases in the US. Tracy, we also know in the past IRS devoted much attention to marketing intangibles as well. And what will the new guidance mean for the US view on marketing intangibles?
Yeah, so a bright line test, like what Joanne was describing, is really not considered arm's length according to rules. However, I mean, we have in the past, and we continue to see more exam teams using this type of test to really assess potential audit risk and potential existence of intangibles. So even though it's not arm's length in the U.S., they do use it as kind of a comparative analysis and diagnostic. I think we'll continue to see that be a focus. As far as how these rules will impact the U.S. and the way that we look at marketing intangibles, again, the 482 rules will be the overarching rules. However, there are things in the drafts, including some of the things we talked about, marketing authorizations, as well as things like local market access fees and specific marketing attributes, things that would create barriers to entries or first mover advantages. Did you get your product first in the market because the U.S. invested a ton of money to get you there? Those types of things are in this draft as potential intangibles. And I think anytime there's something out there like that, there is potential for the U.S. exam teams to grab on to those types of items and assert that those are marketing intangibles as well. So what these examples do is really acknowledge that there's value in those items. And I think what companies will have to do is identify which potential items they have, and then also look at which of the functions in the DEMPE rules actually are performed by the U.S. And this will be the key analysis for intangibles. And I think the U.S. also commented on this, not as much on the risk, but they will be expecting, I think, to see a more robust identification of potential market drivers in the U.S. and how the U.S. contributed to it. And so ultimately, this circles back to the risk discussion we had earlier around really identifying with specificity what the intangibles are and who actually managed the process and controlled the process and funded the potential intangible itself. And in many situations, go ahead, Ronald.
No, go ahead. I thought you finished.
I was just going to say, in many situations, especially related to marketing items, there'll be split functionality around those risks and those functions. And so it does have a potential to push people into profit splits where they may not be in profit splits now.
Okay, thanks for that addition as well. And John, what do you think this will mean for the rest of the world?
Well, first of all, let me concur with Tracy. I think it's going to be more complex given the focus on DEMPE functions to work out exactly who controls all these things, who are the DEMPE functions, particularly in a matrix organization. That all said, I think if we focus on Europe, which is where I come from, there really hasn't been as much attention on marketing intangibles as we've just heard from Joanne in particular. But I think with this new guidance, we could expect that European tax authorities will start putting a degree of focus on it in a different way than they have so far. And what I mean by that is that it's difficult to say at this stage, but it's probable that they wouldn't be approaching this issue using the bright line test or anything similar to the Indian approach. But I think what we would see is more focus on, as Tracy said, on in-territory and the relative contribution of that to the driving of value. Africa, I think, is tending more towards the view of India and China, and so we have clients who've started receiving quite long IDRs across a whole raft of African countries, where you have to think that the reason behind the questions in the IDRs is to attempt to establishing a marketing intangible. I think, though, in Europe, and particularly in Western Europe, this has all been dealt with essentially by looking for reasons to demand a higher margin. So the identification of additional functions, big arguments about the degree of comparability in marking, and things like that. But we have started to see the demand for higher margins over the course of the last 5 to 10 years. And at the moment, there's quite a raft of them in the context of APA renewals. So those are really based on the assertion that taxpayers have made or have started making additional contributions through what have now been classified as DEMPI functions. And I think there's perhaps more emphasis on the E, the first E in DEMPI there, enhancement functions, than on others. So I might be in a country distributing and marketing my parent company or a different brand owner company's product, and my tax authority might say, but you're doing more than that. You know, over years you've learned something very special about your customer base, something very special about route to consumer, and you're adding more value than is currently reflected. But I think that's a different thing to the bright line test. I think it's more likely that we'll see administrations asking for different types of comparables, perhaps even additive comparables. You know, you do 3 functions, I need 3 comparable sets and I add them all together. Or, as Tracy said, I think there might be a bit of a shift towards profit split. It's a bit like gazing into a crystal ball, but what I think we recognize from all of those things is that the simple characterization of something as a box-shifting distributor will be tougher.
Thanks, John, and all of you for the insights on the marketing intangibles. I want to go to some of the questions that are raised, and they are focused on specific industries. I have a question on the technology industry. I have another question coming up here as well. But maybe it's difficult to deal with all these industries here in the call. But I think it shows that many multinationals will be, in one way or another, be engaged in transactions involving intangibles, and they will be affected by the new rules. John, maybe to put it a bit more generic, any specific industries that you think will be affected by these new rules that more than others?
Well, I think everyone's in the net, Ronald. The broad definition of intangibles here is pretty pervasive. I think any multinational with anything that is a non-routine or a defensive intangible will be considered to be engaged in transactions involving intangibles under this new definition. So it's relevant really to pretty much any company with international operations. But of course, some industries are going to be more affected by the new guidance than others in a different way. I'll come on to marketing intangibles again in just a second, but I suppose in my mind it's very simple. The higher the margin in a particular organization, and the more that it's clear that the industry that organization is in is driven by non-routine intangibles, the more focus there will be on it. So I think there's a direct correlation between the knowledge of the world that there are intangibles in a particular industry. So life sciences, for example, technology, for example, is one thing, but the other dimension on it is margin. Very high margins make it much more attractive for people to come and go fox hunting for those intangibles. But I think that when we get back to marketing intangibles, it's going to be particularly relevant in the consumer products industry. So patent and product and process-related intangibles in pharmaceutical and life sciences, and brand, trademark, marketing in consumer products. And I think what that means in some ways, just to step into Action 13 for a second, is with the introduction of the master file concept, it's going to be very clear to tax authorities fairly quickly to get a picture of how companies operate and what IP, intellectual property, intangibles, what intangibles in their industry is really, really relevant. So it'll make comparisons of identified intangibles in similar companies easier, and also a comparison across industries. So everybody really is engaged in some degree of transactions involving intangibles, and those that are operating through highly integrated business models are subject, I think, to more challenges on profit split, where it's not so clear that there's a single or a small defined number of entrepreneurial activities in a in a particular multinational, then it gets more difficult, especially where you've got two high tax countries who are examining transactions with a third low tax jurisdiction.
John, you mentioned profit split. This was one of the action points. Can you explain what happened with this?
I can try. So the OECD released a discussion draft in December 2014 on the use of profit splits in the context of global value chains. It didn't really contain guidance of any material degree. It was more a question of a test of where profit split might be necessary. And I think we remain largely in that position. So it was a number of questions concerning the application of the profit split method, how, when, that kind of thing. But some of the key themes that emerged during the consultation processes included the need to strengthen the guidance on when it's appropriate to apply a transactional profit split and how, since that's not always straightforward. And at the same time, the consultation process confirmed that transactional profit splits can be useful in some cases and help to align profits with value creation. Now, this final report on Action 8 to 10 doesn't include revised guidance on the application of profit split, but it contains a scope of work that will form the basis for draft guidance developed during 2016. So this further work on transactional profit split methods will examine their application to highly integrated business operations, and it'll develop profit splitting factors that show strong correlation with value creation. I can imagine that will be fiercely debated in the corridors of, and indeed the meeting rooms of OECD. It's also going to address situations where comparables aren't available, benchmarking comparables aren't available, because of, as they really call it, structures designed by taxpayers. And what this could do is include revised guidance on the use of profit methods. So we won't see that. We expect to see it finalized in the first half of 2017. So I guess, Ronald, just in a nutshell, we have there's a clear indication that more people need to understand how to do these things, but at this stage we're lacking guidance.
Yeah, John, maybe I can add to this as well. I agree with your earlier comments that more and more assertions of profit split are and will be seen. The SAT is of the view that it is not possible to find comparables that will reflect China's economic conditions. In the draft rules for the first time, the SAT introduced a concept of value contribution allocation method under other method besides the current existing profit split method. The draft rule states that the VCM is usually applicable where it is difficult to find comparables. So with the VCM, which is really a form of profit allocation, we believe the local tax authorities will apply VCM in instances when the information of the supply chain becomes available to them. So the result may be more profits are allocated to China if there's a limited, or even if there's limited or no intangibles in China. So going forward, the local file or the transfer pricing documentation in China, taxpayers will need to disclose the value chain information and analysis. So I think this is actually a contentious point because it means that the tax authorities who are keen to do this kind of profit split approach, then they will have access to the information going forward. And we are yet to see whether the draft rules to be issued in the future will be issued in the same form.
Thanks for chipping in, Joanne. And I know that similar discussions took place during some of the business consultations at the OECD. And some of the countries there were indeed taking the position profit split might be a good alternative when only few reliable comparables can be found. And then some other countries raised the question whether this would imply accepting losses in bad times as well. So the question was not answered by the first group of countries and probably will be dealt with in the corridors and the meeting rooms of the OECD, as you called it, John, next year when the working party of the OECD will work on profit splits. In your view, Joanne, is the value contribution method such that the SAT will also accept losses?
Well, in theory, I think the value contribution method is such that the SAT will also accept losses. But I think it is fair to say that most tax authorities will try to avoid this topic on loss sharing if they can help it. It is always easy to have a competent authorities discussion on how to share profits. But I think when it comes to sharing losses, it becomes much more challenging to reach an agreement. I want to believe at least that the Chinese tax authorities will be willing to share losses, provided the multinationals, they have all the right fact patterns and have a consistent approach year on year.
Okay, and thanks for that. We discussed that the OECD has introduced a framework for analyzing risk allocation. And similarly, the OECD has developed a 6-step framework for analyzing transactions involving intangibles. And one of the steps is to identify parties performing functions relating to the DEMPI functions with regard to intangibles, and to determine an arm's length remuneration for the contributions made by the parties involved. This DEMPI concept, as we mentioned several times by you, and it's very important. Tracy, can you elaborate a bit on the DEMPI concept?
Yeah, so let's start with the analytical framework, Ronald. The 6-step approach for analyzing intangibles is laid out in the final guidance. The first step is really identifying the intangibles and the economically significant risks associated with the DEMPI, basically everything from development all the way through exploitation of the intangible. The second part of the framework is really identifying the full contractual arrangements and determining legal ownership. And the third is really a detailed functional analysis, determine which parties are performing the functions, using the assets, managing the risks related to DEMPI. So very similar to the risk test that we talked about earlier, there's a focus on identifying the intangibles themselves, reviewing the contracts, and doing a functional analysis. And then 4, 5, and 6 is really around confirming the consistency among the legal agreements and what's being done and who are the risks. The 5th one is really looking at the actual transactions and delineating the DEMPI of the intangibles there. And then the 6th is really based on the comparison of what was done, where the DEMPI functions sit, and how the contractual arrangements are laid out to find the appropriate comparables and benchmark the transactions. So again, the theme here is congruence among legal arrangements and stints and your comparables. And similar to the risk test, again, you're going to be looking for where there is material disagreements among those 3 items. But in contrast to the risk section, disputes over the IP residuals may be more complicated, and they may lead to probably higher double taxation situations than the risk analysis. And one of the reasons for that is obviously DEMPI has 5 components, and so many of the DEMPI functions may be done all over the world with many jurisdictions trying to get a piece of the IP profit. And so again, it may lead to more challenging ways to describe the DEMPI function in your documentation, but also just dispersed across many jurisdictions.
Yeah, thanks, Tracy. And you were right that probably before jumping to DEMPI, it would be good to first walk through the 6-step process. The first step mentioned here is the identification of intangibles. And on this, there is specific new guidance, including the definition of what constitutes an intangible. And John, you mentioned that before and indicated that a broad definition has been introduced. And I would like to ask you to focus on the practical relevance of this. Can you tell a bit more about that?
Yeah, I'd love to, Ronald, indeed. So it is a broad definition of intangible. According to the new definition, an intangible is something that is not a physical asset or a financial asset, so an elimination there. Something which is capable of being owned or controlled for use in commercial activities, and whose use or transfer would be compensated had it occurred in a transaction between independent parties in comparable circumstances. So, from a practical perspective, the first thing is you've got to identify all relevant intangibles associated with an intercompany transaction. And in order to do that, you have to look much further. I think we all have had examples in the past of trying to find patents or trademarks, other similar protected IP, where we go and talk to group legal. But as a practical matter here, you've got to look much further than that. So I think in a nutshell, this new definition of intangibles follows the something of value approach that we see in the context of business restructurings. But this broad definition is applicable not just to business restructurings, but to ongoing transactions that happen in the normal course of business. So looking at the slide that our participants are seeing now, you'll see there that they'll be divided into, broadly speaking, 3 categories. The top box mentions goodwill, goodwill and going concern value. The final report provides various examples of goodwill and going concern value, but not a precise definition. And in fact, OECD explicitly mentions that it's not necessary to establish a precise definition, but important to recognize that a part of the compensation paid between independent enterprises may represent a compensation for something that could be referred to as goodwill or value. So that will include or may include fairly subjective concepts such as good management, good reputation. In transactions between related parties, you would probably see a compensation due for such concepts if and to the extent that independent enterprises would have provided a compensation for those intangibles. So between related parties, if we can observe or credibly claim that one would observe the same thing going on between independents, you would be expected to remunerate. And then the box on the bottom of the page refers to what I think is relatively easier stuff, registered IP. So that category contains most of the intangibles that we'd identify if we were looking at a legal or accounting definition of them. So it includes patents and licenses and trademarks and brands and so on. In some industries, that's going to be the most important clutch of intangibles. But there are others where it's quite different, where the most important and valuable intangibles are not legally registered or protected. And those intangibles are in that middle box. Okay? Marketing intangibles such as customer lists, proprietary market and customer data, customer relationships, not just lists, but relationships that we discussed before. So I think it's incumbent on us in doing our analysis and on our clients' sales to be very, very careful in analyzing or reassessing sales, marketing, promotion activities, and ask themselves whether all those activities are properly remunerated. And then there's yet another category of non-registered IP, which is what I think we might refer to as institutional IP or codified methods of generating and maintaining competitive advantage. We come across these in our clients' premises a lot of the time. But outside the world of transfer pricing, these may not be considered intangibles. Things like the company way, things like process maps and mega process maps. But they're certainly examples of what should be considered, at least as potential intangibles for transfer pricing purposes. So in practical terms, that means you've got to go out hunting, and not just with your legal department looking for patents or looking for trademarks and that kind of thing, but also with your strategy team and with people in the organization who know what it is that you have that is proprietary, could be useful to others, even third parties, and at arm's length might be capable of being charged for, even if it's not in what we might call the standard list. It's got to be evaluated whether you have something in this extended list that falls within the definition at the top of the page, and most likely into the unknowns, I suppose Donald Rumsfeld would be proud of me, in the middle box.
Thanks, John. And well, it seems to me, indeed, it will mean for multinational businesses that it will be harder to be considered or should be considered an intangible for transfer pricing purposes. We have a question from the audience, a very practical one. Let me pass that one on to you as well, John, because it relates to what you just said. The question is, given the emphasis on local intangibles, including goodwill, will there be more pressure to perform a two-sided analysis? And would a principal structure with LRDs, limited risk distributors, remunerated with a TNMM still work?
Oh, well, let's never say never, right? Of course, it will always depend on specific facts and circumstances. Let me have a shot at this. In my reading of it, the new guidance doesn't imply the application of a profit split method automatically, per se. So, with the right facts and circumstances, a TNMM at the LRD, limited risk distributor end, with a residual going back to a principal may very well work. But I think there are a couple of points here. The first one is that The term LRD, limited risk distributor, may be accurate on an evaluation of the facts, but as a construct, it's difficult to find one that exists at arm's length. If it does exist, it's probably closer to a kind of agent or something like that, and that would be something we wouldn't want, I think, from a tax perspective. So this label, LRD, and taking it as a starting point is probably not the right way to go. The right way to go is to get into a detailed functional analysis of the activities of that D, that distributor, including any marketing activities that it undertakes, and look at it not only from a country-specific perspective or an entity-specific perspective, but also in the context of the total value chain, starting with what exactly are the functions performed in the specific country. So what would that mean? I think it means three things. First of all, in the context of the profit split thing I said a few minutes ago, I think you'd have to corroborate or attempt to corroborate your TNMM, your standard one-sided benchmarking search, with a value chain analysis, not necessarily applying a profit split, but using a kind of profit split thinking to show that the TNMM margin in the context of the whole. The second thing is that kind of structure, the questioner's structure there, is something that is in high focus. And so it's going to be important to use your transfer pricing documentation, I think, as something more than penalty protection, something that is much more than that, something that is strategic. And in your documentation, with the facts behind you, you can illustrate in depth the functions performed, and indeed those not performed, and move beyond mere labeling and characterization of, in the question, LRD. And then I think the third thing is perhaps consideration of whether an approach that differentiates between various in your group would be needed. We've heard Joanne talk about some special features of China and mention India. I've mentioned some things on Africa, I've mentioned some things on Latin America, and so we look at that, and I think there is an emerging question as to whether what is a distributor in one country, one region, one area, is the same as the distributor in a different one. And it's not because they're necessarily functionally different, but because of macroeconomic features, they are having to operate under different constraints and with different degrees of risk. So the risk of waffling for too long, Ronald, I think it can still work, but the emphasis is going to be on corroboration, detail, and documentation.
Thanks for answering that question, John. Let's get back to the slides where we were, the identification of intangibles. Like I said, it will be harder for multinational businesses to identify what should be considered an intangible for transfer pricing purposes. Tracy, what sources of information can companies use?
So I think the companies are going to need to split the process. First, they're going to have to identify the intangibles, which are legally protected and registered types of intangibles. And then as a second step, they're really going to have to rely on transfer pricing analysis, key value driver analysis, source of competitive advantages, and mega processes have to be identified. And that's all going to have to be done through interviews. So I think taxpayers are really going to have to rely on their businesses to help guide them through the process of identifying any of these broader intangibles that John talked about.
Okay, thank you. Well, then we come now to the third step that I want to jump to already, the functional analysis and the identification of important DEMPI functions. Tracy, can you tell a bit more about the DEMPI functions?
Yeah, so the DEMPI construct is really trying to get to ownership for transfer pricing purposes of an asset. And who gets the return. So if a legal owner is earning all of the returns associated with the exploitation of an intangible, then there's an expectation in this draft that they would be performing the functions, assuming the risks, and owning the assets related to the DEMPI functions, which are development, enhancement, maintenance, protection, and exploitation. Now, the final guidance is different from the drafts in that it does allow for certain of those functions to be outsourced. So what they're really talking about is management and control over those functions. And I think that's an important change that happens in the final guidance, and we just wanted to alert everyone that they did acknowledge that outsourcing of functions can be done, but those are really the functions that they're trying to get to.
Okay, thank you. And what in practice may be difficult, I think, is a determination of what is important, what is an important function. What's your view on that, Tracy?
So again, this is going to come from fact-finding, and the guidance is clear what questions you have to answer. So questions like what drives an industry and what's the company's business model compared to those industry drivers. So how are you addressing it? There's 3 or 4 other questions in the guidance that have to be answered. The reality is that they're simple questions, but it's not a simple task to answer those. And again, it's going to require business input, business process mapping, and ultimately a view of the company of what pieces of their value chain are worth.
Okay, thank you. And this practical experience with DEMPI functions, Joanne, in the Chinese market, any practical experience for that?
So, Ronald, in the consultation draft issued by the SAT, the same DEMPI functions are being applied, but with a subtle difference where China added a P for promotion to reflect the market aspect, such as China's economic growth and purchasing power of its 1.4 billion consumers. So the P will have a particular impact on certain industries, such as the consumer products, pharmaceutical, and luxury goods industries. And in addition, the draft also has a strong emphasis for localization of activities such as trial, production, localized application development, etc. So one of the concerned rules is that the rules do not indicate that certain functions are more important than others. So monitoring and control of R&D projects and implementation of R&D projects are both equally important DEMPI functions. The lack of clarity on this point may create uncertainty when there is a dispute over whether a greater share of intangible-related profit should be allocated to certain more valuable functions sitting outside of China.
So although the OECD document gives concrete examples of what constitute important functions, the report also mentions that the nature of these important functions in any specific case will depend on the facts and circumstances. The report not only focuses on the control over risk related to intangible assets, but also includes examples on tangible assets and financial risks.
Yeah, that's right, Ronald, it does. And in the report, the outcome for the entity that legally owns a tangible asset, the outcome is similar to the situation in which an intangible asset is owned. In other words, if the legal owner doesn't have the capability to control the risk associated with in such an asset, then it would be entitled to, in this case, no more than a free return, both for intangibles and for tangibles.
And John, why does the guidance state no more than a risk-free return? If the entity being the legal owner, how much profit could be allocated to that entity then?
This is a complex one, Ronald, isn't it? Because first of all, I think the reason that this no more than a risk-free return phrase has crept in is because some of the OECD members are of the view that there might be reasons in some cases not to recognize the actual transaction. It's mentioned in a footnote in the report, indeed. So as a matter of recharacterization or disregarding the transaction, I think it's a recognition that the asset, intangible or tangible, the legal ownership of that is worth something, but the more important contribution to its value is the activity surrounding it, the control of the risk associated with it. And I think that's why they've got down to this phrase of no more than a risk-free return. On the other hand, of course, so that's going to be the case if the authorities can prevail in a view that the transaction isn't commercially rational. But if the entity does control the financial risk associated with the, say, funding of development or ownership of the tangible or the intangible asset, then it could be allocated a financing return. Now, that's a matter of intense debate. There's a lot of debate on what that return should be. Should it be an element of the profit share in the return associated with the asset? Is it comparable to a plain vanilla loan? Is it something between the two? Is it a risk-weighted return that it should get? And what the report says at this stage is that the level of financing return depends on the exercising of control over the financing risk. But there's no real definition around it at this stage. The OECD's indicated that they'll be determining or moving towards a determination of what the financing return would be as a part of the further work on the transfer pricing of financial transactions through 2016 and 2017. So I think what we have is a conceptual acceptance that with a degree of control over the asset, tangible or intangible, there will be a ownership that is more than a routine return, a risk-free return, but we don't yet know how much more.
Okay. And I guess then that means that multinational businesses have to review their ownership structures and pay attention to the function performed, specifically when it's not aligned with legal ownership. Tracy, if we move to the revised Chapter 6 of the guidelines that touches upon benchmarking and evaluation of transactions, what are your thoughts about that?
Yeah, just a couple key takeaways. Stricter standards on comparables. I think a higher bar, and companies are really going to have to rely on making sure they either make adjustments to third-party comparables that they're getting out of databases and acknowledging there's differences, or they're going to have to turn to their internal comparables to look for things like profit splits or implied profit splits in deals. These things are quite common, but it's just important to note that there's a level of rigor that's being asked for here that may not have been applied previously. And one other thing to note is that cooperative methods will also be important because when you have this level of rigor, you almost by design have less comparables supporting your transaction. So having another method really can serve as a judgment for reasonableness.
Okay. One specific type of intangibles discussed in the final report is the so-called hard-to-value intangibles. The OECD provides a specific approach for dealing with that type of intangibles. John, can you briefly summarize what a hard-to-value intangible is and how this specific approach would work?
Yeah, I can, Ronald, and we need to keep it brief, don't we? I think a hard-to-value intangible, HTVI, is something where no reliable comparables exist at the time of transfer, and there may be unreliable or not fully reliable projections of future income or cash flow. There's uncertainty about it all. So what this does is to say, well, we in those circumstances, we really want to protect ourselves, the government, against asymmetry. That is, something is licensed or transferred in some way with a certain set of assumptions which then do not materialize, and as a result, one of the two parties to the transaction is materially disadvantaged, and there's a consequential tax effect. So I suppose the executive summary form of this is that they've introduced a number of checks and balances, but the most important one is that they will retain the right to look at these kind of things after the event, essentially with hindsight, and that they will effectively, therefore, have something in the armory that looks a little bit like the US commensurate with income standard. There are some other things as well, things like price adjustment clauses expected to be routinely included in arrangements or agreements between related parties, even though, frankly, we don't see too many of them between independent parties. So I think what that boils down to in very, very simple terms is a look-back provision and also, therefore, the ability to apply a degree of hindsight if taxpayers choose not to remediate matters where there's been an unexpected mismatch. But they're going to provide some further implementation advice in 2016, where that really applies, what's material for these purposes, how long the time periods will run, and all that's going to be considered up to 2020 in the light of further experience. So it's a rapidly developing thing, but essentially the headline is there is a look-back provision. We can no longer have unexpected circumstances giving massively favorable tax outcomes without an expectation of challenge.
Thanks, John. Let's move to another topic, that of transfer pricing for services. The new document contains an update of Chapter 7 of the transfer pricing guidelines. Any news here, Tracy, in the OECD guidance compared to the 2014 draft?
I think the biggest news is obviously the inclusion for a new category of low-value services, right? And for those, it says a 5% markup can be used. I think this is trying to get to help taxpayers manage what are pretty routine transactions that they commonly have with many multinationals. So overall, good news. I think the thing to be conscious of, and I'm going to steal some stuff from Joanne, which is really around, there's specific local country rules also to consider, though, when applying that. China, for example, their draft rules introduce a new chapter on intergroup services and state that for such transactions, a special report and file needs to be ready when you file your tax return. And I think the importance here is they're really looking to benefit test. They're really looking for a description of the services, whether or not they're stewardship-like. And I think as many of the Asian countries look to China for direction, you may see this type of special report pop up that you'll have to file something similar. So while the OECD guidelines are, gearing towards trying to simplify and use the 5%, you really still have to consider local law on this one.
Okay, thank you. The guidance looks also at services that cannot be provided at cost. At the same time, a similar question pops up in the context of cost contribution arrangements. Tracy, what does the final report says about sharing costs under a CCA? Yep.
And so these are common themes, right, where they're willing to accept these types of arrangements if each party is contributing costs and generating value that's all similar. And what the new rules are really designed to get to is we understand everyone's contributing costs, but what's coming out of that is an equal output that still sharing costs makes sense. And I think this is one where it's going to get very specific around what the cost contribution agreement is about and really how similar the costs are that are being shared by the parties who are involved in the arrangement.
Thank you. With the publication of the 5 October documents, the OECD has completed the actions 8 to 10. However, quite important follow-up work is scheduled for 2016 and 17. John already referred to that before. This relates also to the attribution of profit to permanent establishments, as was mentioned in our prior webcast on PEs, work on financial transactions and on the application of the profit split method. And further, the final report will be supplemented with further work mandated by the G20 Development Working Group, following reports by the OECD on the impact of base erosion and profit shifting in developing countries. We are nearing the end of this session, and I know for our panelists it's hard to come up with one single most important point out of the 190 pages of the document. But I would like to ask you your key messages. And let's start with the ladies. Joanne?
Thank you, Ronald. The rules to get to the arm's length result have become far more complicated, and the next few years we will expect to see increased controversy. So the difficult question, I think, faced by multinationals now is whether to adopt the BEPS approach right now, and if so, what do you do with prior years and the inconsistencies? Tax authorities have already started to take actions. Taxpayers should bear in mind that whilst tax authorities, they are looking for transparency, taxpayers, they are after certainty, so there's a balance here. It is therefore important to ensure that there's an awareness of the risk in the organization. What are the risk level and certain information on the value chain when disclosed to the authorities? What are the exposure and the strategy around the disclosure of the information?
Thanks. Tracy?
Sure. I think the biggest takeaway is the alignment that's being asked for between contract, substance, and comparables. And really, taxpayers being proactive where there are misalignments, because there will be some naturally, really assessing whether they're material or not to support their arm's length pricing.
Thank you. And finally, floor to you, John, with your key takeaway.
You're going to need more corroborative methods, more detailed analysis on full value chain, just as Tracy delineated earlier. And in a world where profits start by following contracts, providing the behavior of the parties means that the control functions, the DEMPI functions, are in the same place as the legal ownership of risk, it's going to be quite a trick to keep up with tracking who are your people who carry out DEMPI functions, where are they, and what are they up to. So I think, don't shoot the messenger here, but I think the degree of analysis needed and the degree of tracking of business activity is greater.
Well, thank you, and that brings us to the end of this webcast. I would like to thank Joanne, Tracy, and John for sharing their views and experiences with respect to the latest BEPS transfer pricing developments with all of you and me on this webcast today. I really appreciate all your time and effort. I also want to thank you, our audience, and I know that for some of you this has been very early or very late, and I want to thank all of you for your attention and your questions. If you have been with us for the full 90 minutes, if you have responded to the polling questions and completed the feedback, you can now download your education certificate by clicking on the purple CPE icon at the bottom of your screen, of your interface. Now, before you sign off, please take a moment to open the red feedback icon and let us know what you thought of today's program. And as always, we hope that you'll join us for future webcasts. From the Thought Center, I'm Ronald van den Brekel, and we've been bringing you insights into the latest developments in the OECD BEPS project from EY.